Welcome to the Infra Insider podcast from Infra-Be, a leader in renewable energy and infrastructure executive search. Join us as we dive into insightful conversations with industry leaders, pioneers and visionaries shaping the future of infrastructure and renewable energy. Discover the latest trends and innovations and challenges driving the transition towards a greener and more resilient future. Please remember to like and subscribe. We are joined by Phil Kent, CEO of Gravis Capital Partners. Gravis Capital manage and create funds that do something a little different by giving investors access to the more stable and predictable side of many of today's interesting themes, from infrastructure and real estate to clean energy and digital assets. Whatever the sector, the result they aim for is reliable, long-term income for all of their investors. Currently managing a staggering $3 billion of assets. The business over the last 3 years has undergone some exciting changes, notably Oryx, a large Japanese financial services business, becoming a major shareholder. There's been some exciting changes across the senior management team, with some new appointments that Infra-Be have had the privilege of being involved in, and most recently an announcement whereby they are going to be merging some of their existing funds. A topic I'm sure we're going to talk about a little bit more in a bit more detail. Today, we're going to be talking to Phil about his journey to CEO at Gravis. We're going to be looking at Gravis's strategy and, most importantly, how the business is going to be navigating the ever-changing and incredibly exciting sector that is, of course, infrastructure and renewable energy. Phil, welcome to the Infra Insider. It's an absolute pleasure to have you on the show.
Thanks, Daniel. Good to be here.
I hope I've given the introduction justice, but I'm sure you can correct us as we go. For us, as headhunters and recruiters, we're always really interested in delving into people's careers. Phil, you've had a very, very interesting career across infrastructure. You've been at some major shops, but you've obviously spent a long period of time at Gravis. Phil, tell us about your career and your journey and what led you into the current role as CEO.
Yeah, thanks, Daniel. I think it's been a journey that's not necessarily been planned. I think the approach I've taken throughout has been to take opportunities as and when I've seen them in interesting areas. And leaving university, I studied geography at university. I guess I've always had an interest in the environmental energy sector. I work for a management consultancy and focused on the energy sector, and spent quite a lot of time over with at the time Dong, now Ørsted in Denmark, and that was my real introduction into the energy markets, as well as doing a lot of power station valuation work in the US. And then after that, moved to work for Gazprom Marketing and Trading, and that was really as Gazprom were growing their energy business in London, and it was a great opportunity to work across a number of different commodities in a business that was growing pretty rapidly, and obviously had significant support from its parent at the time. And for various obvious reasons, that business is very different where we sit today. But it was a great learning experience for me. And the latter role I had there was working in their clean energy team, looking across a number of the carbon credit trading mechanisms to effectively finance projects in developing countries to generate carbon credits that the business could use as part of its trading platform. That was my introduction, I guess, into clean energy investing, which I had the desire to build on and follow, and did that at Foresight Group, where I worked on a number of the green investment bank funds and public funds that they managed in the energy environmental sectors. And I think that was a great opportunity, and I'm hugely grateful to Foresight for their experience in terms of learning how projects get pulled together. And I think, given we were managing funds that by definition were targeting sectors that were nascent or underserviced, we really had to work very hard alongside the rest of the team to pull projects together and work with developers to get projects to a point where they were fundable. So there's some really satisfying investments that we made on behalf of the GIB, and investments that have gone on to do well for their investors. And ultimately saw an opportunity at Gravis and moved across to this business around 7 years ago, and haven't really looked back. I think the business has continued to give me opportunities to grow and develop, and I think as long as I'm learning and I'm doing something new, I think I'll be content and happy. And for the last 5 years or so, I've been managing our main GCP infrastructure investments vehicle, which is a £1.1 billion investment trust focused on investing in UK infrastructure debt. And that's been a great experience in terms of how both on the investment side, which is where I've absolutely focused, but in latter years, much more dealing with the investor base and the board of directors, the public market vehicles that are investment trusts. And most latterly, at the end of last year, took on alongside that the role on our GCP asset backed fund. And as you said, more recently took on the role of CEO here at Gravis, which is another exciting development that very much complements my existing roles, and they haven't gone away, but we're also recruited to support the growth of the business that we see.
I mean, it's an incredibly exciting journey, and especially that in your earlier years, not completely traditional. And I think it'd be interesting for people listening in and watching to learn how you can kind of move into becoming a primary investor. Back in those days, I think it is a bit harder. So you've obviously done incredibly well. You've had lots of different experiences and worked in different companies, and I'm sure they've kind of formulated lots of learnings along the way. Now, as a CEO and a leader of a business and a leader of people, what do you feel that your main learning points are from your past career history?
I think for me, it's kind of an inquisitiveness, perhaps, and not be scared to learn about new areas. I think as you say, I think I've worked for very different companies that have approached investment perhaps in slightly different ways, and I think no two companies approach investing or using their capital or their capital allocation in the same way. So I think having that experience is really helpful. I think from a project perspective and looking at investment, I think one of the questions I often ask in interviews is, where do people feel most naturally comfortable? Is it the numbers? Is it the legal aspect? Is it the technical? Is it the kind of more commercial aspects of a project? Is it a project as a function of infrastructure projects, a function of lots of different disciplines coming together to get something built, operated, developed, and different people have different skill sets to bring to that. No one project is ever a function of any single individual. So I think finding where your comfort zone is really important, but I think equally important is an ability to step outside of that and get an understanding of those other areas. And I think that's something that, if I look back, I've really enjoyed doing. And whilst financial modelling and analysis has probably been core since day one, I think an understanding and appreciation of all the other disciplines that are needed to bring a project together. And you'll never be an expert in any of those areas, but I do think in terms of a primary investor role, having an understanding of the different areas to at least ask the right questions or make sure you're covering off the right points is really important. And I'd urge anyone to try and develop as broad a range of skills as possible across the different components that are required within a project finance or investment consideration.
So that's interesting, isn't it? Because of that journey, that exposure to, I'm assuming also multidisciplines as well, has kind of tailored you and built you into the leader that we see today. But it's interesting how you go out to recruit and what you ask for. You're not trying to put people into, well, not putting people into spots, but almost creating the right spot around the person, which is probably why, when you look at Gravis, the track record, not only the deals and the investments, but also there's a serious longevity and incredible culture across your business, which is lovely to see. You're often termed as the nicest man in infrastructure, and I think I can totally agree with that. Thank you for touching upon your career history. I think it's really interesting, and I'm sure people can delve into your profile on LinkedIn to get some further insight. I think what I wanted to also ask you about today and sort of get straight into it is there has been a recent announcement about the merger of the funds, and I think that it'd be really interesting to just get some further insight into that. Obviously, there's been some interesting press and there's lots of articles out there, but it'd be great to hear it from you.
Certainly, very happy to. I think the market, I mean, what's happened in the last 18 months is a pretty dramatic and pretty quick repricing in credit markets in response to central bank rates increasing, concerns over pervasive high inflation. There's been a repricing of debt and repricing of returns across the market generally. Infrastructure as an asset class, and I think particularly at the more retail end of investors, has been a really helpful and really effective fixed income alternative during the last 10 years when traditional sources of fixed income, whether that's gilts or corporate bonds, have been offering significantly lower returns. What's happened now is both a repricing of infrastructure, infrastructure traditionally being long dated returns, which are very sensitive to underlying interest rates from a valuation perspective. But also we've seen a wave of capital exiting the infrastructure, renewables, alternative space more generally in favour of sectors that are more traditional fixed income sectors that suddenly and pretty quickly are able to offer attractive yields. So infrastructure and real assets and alternatives have a job to do to reprice, to align themselves to that prevailing market. And where we find ourselves, and I think a number of trusts across the market are in exactly the same place, is that the funds that we manage, which are listed investment trusts, are trading at discounts to their net asset value. And that's pretty unprecedented over the life of those funds. They're typically traded at premiums to their NAVs, and that's been a function of the attractiveness of that income stream relative to other sources. So the response to that from investors, our investor base, has been, what can we do about that discount to try and reduce it, to try and realign the share price with the net asset value? So we've heard that feedback, and I think as Gravis, we've always taken the approach of trying to listen to shareholders and respond accordingly, and we put some proposals on the table to merge the two vehicles together. And I think the core thesis and rationale for that is that we think that merging a vehicle with benefit in terms of accelerated ability to reallocate capital, whether that's return capital to shareholders, and there's a fairly significant commitment to return capital to shareholders as part of that, to deleverage at a fund level, so to pay down the fund level credit facilities that, given the current market movements, look far less attractive given their cost, but also to ultimately reinvest capital to realign the portfolio returns with the prevailing market rates. And we think that can occur quicker, certainly in the case of GCP Infrastructure, as two vehicles rather than one. For the investors in Gravis, which is a smaller vehicle, we think there's benefits to being part of a larger vehicle with more secondary market liquidity and scale. So that's been the premise that I guess we've put to investors, and I should very much emphasize that we haven't done a deal wrapped in a bow, asking investors to vote on it next week. We've been engaging with investors significantly over the last month or so since announcing those proposals, and I think we're in a phase now where we'll listen to investor feedback and work out which way to go. I think both funds can go through that capital reallocation exercise in their own right, and I suspect it looks slightly different, and that might be the favoured route for investors. We've put some proposals on the table that we think are constructive and sensible, and have been engaging with shareholders to understand. I think the key message there is we're trying to be proactive about a market that is quite difficult at the moment for infrastructure more broadly because of the general rate environment. So we're responding to that, we're asking the question, and we'll respond to the feedback as and when it comes.
Listen, it's good to see that you're navigating those shifts in the market. It has been difficult. That being said, you always have to go back to the fact that infrastructure investing is a long-term game, and yet I think all investors are currently in that spot at the moment. But I think that it's definitely positive for the future. It's great to hear that Gravis are making those changes. Alongside those changes, Gravis have obviously made some recent new appointments, and I suppose of those appointments, that probably ties into your vision of how you're going to navigate in the space. And therefore, what I'd like to kind of bring us back into now is that strategy of potential new fundraisers and potential new investment strategies, and what you see as the investment class and the strategy for the future of Gravis in the market?
Yeah, you're absolutely right. We have made a number of new appointments in the business, and I think the Gravis has been on a transition over the last 3 or 4 years from a founder-led business that was managed by the 6 or so original founders that set the business back up in 2008. And in the start of 2021, Oryx Corporation, as you mentioned at the start, Daniel, acquired 70% of our business, and that's a really exciting development for our business. The fact that we've got one of the world's largest companies which has investment activity in the energy and environmental space, and also significant investment activity in the asset management space as our majority owner, for me is a really powerful addition to our business that can provide support in terms of the expertise it brings and its balance sheet strength and support to the extent we can access that. And I think particularly during a time of difficulty for the market, having someone that is willing to take that long-term view that the market is to a large extent cyclical, and we expect the attractiveness of infrastructure to return at some point, for me is really important. And I think we've looked at how the infrastructure market has changed alongside the merger proposals that we put forward and that we just discussed. We have changed made an incremental proposal for our investment policy, recognising that from a UK perspective, and we are historically a very UK-focused investor, the willingness of UK government to offer or procure private sector financing to infrastructure has diminished. Mechanisms like PFI, PPP are behind us. I think a lot of the renewable subsidies have now come and gone, with the exception of the contract for difference, which predominantly supports offshore wind. So we need to adapt, and there are still lots of attractive opportunities in sectors that have contracted, predictable income that form the basis of the core thesis of infrastructure investing. I think the aspects of the market that really excite me at the moment is that from a UK perspective, and I extrapolate that to other parts of Europe and the world more broadly, has a huge job to do in terms of decarbonisation. A lot of the investment so far has focused on energy generation, and particularly wind and solar. But the complementary asset classes to that, whether that's baseload renewables, of which we've done quite a lot through our existing vehicles, or battery storage and flexible generation, which we've also had exposure to complement a really rapid decarbonisation of our electricity system. In the current commitments, that's 2035. Under a Labour government, that would be 2030. But I think what that's also missing is the fact we've got a huge amount to do in decarbonising heat and decarbonising transport, how we decarbonise our agricultural sector, how we decarbonise industry, how we take carbon out of the atmosphere and store it through carbon capture and storage. A large chunk of which is going to rely on infrastructure development. There's some R&D that's needed, there's some private equity investment that's needed there, but there's a large amount of just physical concrete assets that are going to need to get built as part of that transition in a pretty short time frame. So aligning our business to benefit from the investment opportunities in those sectors, both through the people that we have with expertise in those different areas, but also the funds that we have and access to investors who are targeting those areas is definitely a direction of travel that I'm positive about. I think it's been sad to see the news in the last week or so about the state of some of our infrastructure inspectors' schools, and I think the UK also has a huge job to do to maintain and renew its existing infrastructure before we get too excited about how we respond to challenges like decarbonisation and ageing and growing population that will fundamentally mean we need to do more than we've done already. And I think that investment in requirement in core infrastructure we mustn't lose sight of as well. So from my perspective, and how I think we're going to create value in our business, but also opportunities for the individuals in our business, both current and hopefully new in the future, to grow and develop, is going to be maximising the diversity of investment opportunities we can target, the funds that we have access to invest in those, and the investors that we speak to. And so that's what I'm very focused on building, and I think we've got a really supportive partner in Oryx to do that.
I mean, listen, it's just, it's wonderful to hear. When we talk about sustainable investing, people just automatically think about wind and solar, but it's not. It's about heat networks, it's about storage, it's about close linked salmon farms. We could go on. So it's lovely to hear that Gravis have got the appetite. Infrastructure, investment is about innovation and very much so about risk. It's clear that Gravis have got that appetite. how do you balance evaluating new investment opportunities against that risk?
This is something that I think is the core question that I guess we get asked on, and certainly our existing
Sorry.
fund. No, and I'm very happy to, which means that hopefully I should have a good answer. I think I guess we have the benefits, I think, and I think is a key strength of our vehicles, that they are targeting diversified ranges of asset classes. It's not a solar fund or a wind fund, where I think the risk is you get pigeonholed into a certain sector and you live or die by the evolution of that sector. The fact that we're diversified, however, means we do need to address the point, how do we measure risk in new sectors, and how do we monitor and understand the evolution of risk as we move into new sectors? And I think it's a two-way, it's an approach from both sides. I think there's how you shape deals and how you take the principles that you've used before, which you come back in infrastructure investing to project finance principles of trying to understand contracted cash flows, the risk, effectively allocated risk through contractual mechanisms to those parties best able to manage those risks. So there's an element of deal structuring that you need to do, but there's also an acceptance that you're not going to be able to package everything in exactly the same way. So you do need to understand new markets and new asset classes. And for me there, it's having the it's having the humbleness to accept that we're never going to be experts in all of the areas across all of the different disciplines we invest in. And our job is to make sure we've got the right advisors on board at any point in time, and that we can sit in the middle. And perhaps it comes back to my earlier comment about being inquisitive about different areas, to appreciate that you need to understand the property components, the commercial components, the legal components, the technical components, the insurance components of any given transaction. And you need to work with advisors that are well placed to do that in new sectors. And the advisors we work with to do that for a wind farm will be very different to the advisors we work with to do that in a recirculating aquaculture system or a vertical farming installation. And I think increasingly that range of advisors is growing. I think the importance of ESG assessments going into investments is quite rightly there, and I think there's advisors that we need to bring on board to support us to conduct the upfront assessments and to build that right governance framework around assets. So I think it's deal structuring and knowing what you're aiming for and the risk profile that you're trying to target, but also working with advisors to make sure you understand how that works in the context of a new sector.
Thank you, Phil. And it's great to hear that there are such strong advisors out there, and clearly you've got your current employees, but there's also some incredible partners around you that are ensuring that you are making the right decisions at every single point. You might not be able to answer this, and that's fine if you can't. Can you give us an example of a recent investment that the team's made around the realms of this sustainability theme?
Yeah, certainly. So the last one of the last investments we announced on GCP Infrastructure Investments was the financing of a fleet of 200 or so LEVC black cabs that I'm sure everyone will be familiar with if you've been to London. And we thought that was an interesting opportunity, working with a large fleet operator in London, as well as a business that has, I think, been leading in terms of how the measurement and analysis related to the emission savings and benefits associated with the transition from diesel cabs to electric cabs is measured and analysed. That's a kind of vehicle lease financing model, so it's slightly different from the stuff that we've done before, and I think goes to your point about the need to innovate in new sectors, and that's something I think across the life of Gravis funds, we've been an early mover into new sectors, and we've been innovative about trying to get into sectors early and develop financing structures that work in different sectors. We're one of the first investors in wind and solar in the UK, first lenders into AD and biomass. A recent transaction was funding the UK's first operational geothermal well in 37 years in partnership with the Eden project down in Cornwall. So I think if we can continue to do that, I think the financing opportunity is a good example of that.
Wow, that's an amazing investment. And how long is it since an investment's been made in that space?
In the geothermal space, I think it's the first operational geothermal well in 37 years in the UK.
Okay, wow. So clearly, again, I think that it's clearly a really strong investment. But again, I think it's all about, from my perspective, I think a lot of funds have been held back by being shocked by what the market's become. But you're clearly evolving, and it's all about taking the risk in the right way. you gave us the explanation around that. It's good to see that you're making those moves. Are there any other upcoming changes, any new appointments coming into the business that we should have a look out for, that kind of complement your ever-changing strategy?
Yeah, there's certainly are. So we've announced that a Chief Investment Officer will be joining our business at the start of October, and we're really excited to get that individual on board, and there'll be an announcement made on that in short order. We've also publicly said we're looking for a new head of private credit, and I expect that we'll be able to make an announcement about that pretty soon as well. So there's 2 senior level hires into our business that I think the message that should give the market is that we're committing to senior resource, and we're continuing to believe in these sectors during what is a pretty difficult period for them, and that we see that there's long-term value in infrastructure, real assets, and credit. So
yeah, and some really strong hires. And I think that just in general, obviously selling our own business a bit here, but obviously it's complement to Gravis's ability to ultimately attract this, because we're only ever as good as our clients are. And what I can say is it's been refreshing. There's obviously other people that you've brought into the business as well that really support that sustainable angle. Phil, it's been a real pleasure to gain further insights into your career, into where Gravis currently are at the moment, and I'm sure our listeners, are going to really enjoy listening to this episode. I want to really thank you for being part of the show.
Thanks for the opportunity, Daniel. Thanks for your support over the last number of months as well. It's been gratefully received, so appreciate that.
It's a pleasure. Thank you so much, Phil.
Thank you. Bye.